A few people in their lifetime may stumble into financial security. But most people will attain financial security by saving and investing over a long period of time. Knowing how to secure your financial well-being is one of the most important things you'll ever need in life. The good news is you don't have to be a genius to accomplish financial security. You only need to get the facts about saving and investing and follow through with an intelligent plan. And over the years you should be able to enjoy the benefits of setting up that intelligent plan. Welcome to BitSauce, your weekly crypto show. My name is BitJoe, your loyal crypto bro on the tube. This content is for educational purposes only and is not suitable as financial advice. If you need investment advice, you should seek a duly licensed professional. In today's show, we are going to dive into investment plans and strategies to adopt in the crypto world so we can protect ourselves from selling too late or too early. After the show, we should be able to declare openly that we won't be either bag holders or paper hands anymore. We will finally possess a blueprint that will help us reach the moon safely. As you may have noticed from the recent bull run, the cryptocurrency market has a strong power to provoke interest. You hear stories every day about average Joes making insane life-changing fortunes. Yeah, little Joey just made an ish ton of tendies by YOLO it all on Doge. He picked up his Lambo not too long ago. These moon trip stories are more than enough to get you to dive into crypto blindly. When it comes to crypto, there's an unparalleled sensation of missing out. It's easy to FOMO, then YOLO and then boom, yo-yo. You on your own. Cryptocurrency FOMO is a serious issue in the community, and if you suffer from it, it can lead to really bad mistakes. FOMO is the kind of mentality that gets people investing in ICO scams, gets people panic selling, paper handed the moment a crypto dips, and insisting on getting insider deals on tokens that never go anywhere. If you're going to place your hard-earned money and faith in crypto, you have to treat it like an investment vehicle, not a mindless gamble. Investing is never an emotional act, and if it is, you're doing it wrong. When FOMO, you can easily jeopardize your financial wellness. Before you FOMO, always remember, for every instant millionaire the media glamorized, there are lots of people who dumped, better known as YOLO, their life savings into a ticking time bomb. These people brought into the idea of something greater and envisioned financial windfalls. However, being an early adopter or a visionary isn't enough. You need a plan. You need an intelligent plan to protect your investment. In crypto, a man with a plan is a man with advanced gains. Even though digital currencies are very volatile and harder to evaluate, you still need an investment plan. This plan will ensure that you understand your investments, and also will serve you as the guardian angel that will protect you from selling too early or too late. Just saying I have a long-term outlook doesn't constitute a plan. You need a well-written plan that can protect you from hasty emotional decisions. Recognizing how volatile is cryptocurrency might make you wonder how to create a cryptocurrency investment plan. Coming up with an investment plan for cryptocurrency isn't as complicated as you may think. In reality, the fundamentals of an investment plan remain the same across asset classes. The universal premise is that you need operating procedures to keep your investments in check and on track. Otherwise, you risk making emotional decisions instead of logical ones. Many cryptocurrency tokens, even relatively stable ones such as Bitcoin and Ethereum, frequently have very volatile market swings. The cost of these tokens can fall 80% one month and then rise 400% within the next few months. The volatility made it very difficult to adopt a short-term plan. That made hodling the most consistently fruitful cryptocurrency investment strategy, at least historically. This method has proven to be one of the most simple and effective strategies, both for newcomers and seasoned crypto veterans. Essentially, this means that you invest and hold on to your assets. Purchasing low and riding out the storm requires minimal effort, long as you conduct the correct due diligence and risk management. Hodling for the long term simply requires a basic understanding of fundamental analysis and strong hands. You will definitely need strong hands when the FUD start to take the market hostage. FUD stands for fear, uncertainty, and doubt. It is nothing but the intentional spread of misinformation by big-time influencers, financial institutions using big media to drive prices down so they can manipulate the market to their advantage. Another strategy that can help reduce the impact of market volatility is dollar cost averaging. Dollar cost averaging is a good strategy for investors with a lower risk tolerance. Imagine what can happen to someone with a lump sum of money to invest that decides to put it into the market all at once. That person can strike disaster. That investor runs the risk of buying at a peak, which can be unsettling if prices fall. The potential for this price drop is called a timing risk. Instead of going big, that person can use dollar cost averaging to toss the lump sum into the market in smaller amounts. Dollar cost averaging can help lower the risk and effects of any single market move by spreading the investment out over time. Besides dollar cost averaging, you can mimic value averaging strategy, which aims to invest more when prices fall and less when prices rise. In the stock market, value averaging is conducted by calculating predetermined amounts for the total value of the investment in future periods, then by making an investment to match these amounts at each future period. Because of the difficulty to determine the future value of any cryptocurrency investment, we are just going to invest more when the price is down, and less when it's up. The investment amount will be up to the investor to determine, depending on his or her risk tolerances. Now that you've learned the two-in-one strategy of investing in cryptocurrency, which were dollar cost averaging and value averaging into hodling, it's time to educate ourselves on how to research among all the existing coins, so we can decide which ones are going to make it into the portfolio. If you've been in crypto long enough, you probably know that asking others for advice can be a total waste of time. Knowing how to research cryptocurrency will not only save you lots of money, but it will also improve your future investment decisions. In other words, being able to identify potential opportunities can increase your successful investments. Doing your own research is all about getting different angles and opinions about a coin. Searching through forums, watching YouTube videos, talking to people can be powerful tools in your toolbox. Always put in mind that the more tools you use, the more confident you will feel in your final decision. Each tool or method can be used to get a better understanding of the sentiment surrounding a coin, as well as the future plans that may increase its price. Exploring social media platforms should be taken very seriously. Each platform offers specific insights, and the past has repeatedly shown us that, when a coin is heavily shilled, it should see an increase in price. But social media is not the place to ask for advice, as most people are simply there to follow the crowd. The point is to see what the masses are attracted to, what coins they will likely invest in. Social media is a small piece of the puzzle. As with everything, you will need to get a global viewpoint. In this case, upcoming events can be a great information point, especially if you are able to identify how similar events worked in the past. To do this, you can use CoinMarketCal and search specifically for the coin you are interested in. This will help you make better short-term predictions. Fundamentals research of a coin should not be taken lightly. As a long-term hodler, you should check a coin's fundamentals to discover its real-world usability. In most cases, new coins are simply trying to do what existing coins are already doing, but better. This is not something that, in my eyes, will make the coin stand out. Building a smarter smart contract will not automatically make a coin more valuable than Ethereum. Allowing more transactions per block will not make a coin better than Bitcoin. What we need to be looking for is that 2% of coins that are actually trying to solve a real-world problem. The coins that bring something new to the table. In most cases, this will be the most time-consuming process. Not only will you need to read through the white papers of each and every coin you are interested in, but you will also need to explore existing concepts and how these are currently performing. Can these projects deliver upon their promise? Can the decentralization of a given industry improve user experience? Or is it simply a way for the founders to fill their pockets, as we have so often witnessed? Discovering trending topics is also essential and often overlooked. When looking at how to research cryptocurrency, checking trending coins and events should be on top of the list. The best way to analyze the market sentiment is by getting a good overview of the number of people searching for a specific topic. Certain keyword tools can offer a great advantage when searching for trending topics. For example, you can use Ahrefs to see how many pieces of content have been written on a topic month over month, and KW Finder to analyze the month over month search volume for a certain keyword. Utilizing the power of niche forums like Bitcoin Talk or crypto-related subreddits can also be very useful. They can provide more in-depth information regarding the coin you are exploring as well as its upcoming events. Also, you will be able to talk with individuals that may be more experienced than you, by starting new topics on your point of interest. If you need to make a more in-depth observation point, you can also take a look at the transaction volume of a coin over time. This observation can help you extract good information about the supply and the demand of the coin. Now you've learned how to research your coins by exploring social media platforms, analyzing upcoming events, researching the fundamentals of the coin, discovering trending topics, utilizing the power of niche forums, and observing transaction volume. It's time to determine how to find entry point and exit point in any crypto trade. Your entries and exits are a vital part of your trades. A great entry is the cherry on top of a profitable trade, while with exits you're not just considering profits, but also losses. Planning your exit points is a vital part of a solid risk management strategy. But picking the perfect entry and exit is tough. Thankfully, there are some skills you can learn to help you along the way. Here how you can identify entry and exit points when trading crypto. Crypto market is way more volatile compared to traditional markets, which means there are also more opportunities to gain on the price swings. But to make profit in the volatile crypto market, you should choose entry points wisely. Traders usually base their moves on either chart analysis or news events like regulation, hacks, cryptocurrency bans, forks, etc., that may trigger price jumps or drops. The chance of a successful trade is the highest when technical analysis indicators meet the trigger events. If the price movements in case of news events are nearly intuitive, looking at the charts won't do too much. Let's lay down the most common indicators that may help to spot an entry point. We will review an indicator of each type: trend indicator, MACD, momentum indicator, RSI, volatility indicator, Bollinger Bands, and volume indicator, OBV. Technical indicators are not limited to the ones mentioned, but we hope it will give you a comprehensive picture on how to catch a moment to open a position. Trend indicator, MACD. One way to confirm the trend is MACD, moving average convergence divergence indicator, which is composed of MACD line, 26-period exponential moving average, EMA, subtracted from a 12-period, EMA, and a signal line, 9-day, EMA. MACD is often represented as a histogram and serves for traders to estimate how strong the trend is. Momentum indicator, RSI, just another indicator that may come handy in spotting an entry point. Relative Strength Index, RSI, is calculated using average number of periods closed up and down. The value of RSI ranges from 0 to 100, with 30 being a signal that a coin is oversold, and 70 that it's overbought. The closer the return value is to 0 or 100, the stronger turnaround in price will be. You shouldn't forget that for volatile crypto market, RSI used solely is merely enough. Volatility indicator, Bollinger Band. A lot of traders use Bollinger Bands to spot an entry point combined together with other indicators. Bollinger Band is a chart composed of two lines that lie a standard deviation away, positively and negatively, from a moving average line. The price crossing the lower band is considered a buying signal and vice versa, but it's best used when combined with other indicators such as RSI. Volume indicator, OBV, unbalanced volume, OBV, is an indicator calculated as a total volume and graphically represented as a line. The indicator adds the trading volume if the previous period closed positive and subtracts the volume if the day closed negative. OBV can confirm price trends and indicate future price reversals. If the prices fall while OBV rises, it can foreshadow a price increase and may vice versa. Also, OBV moving along with price serves as trend confirmation. One last thing left to mention is that the best moment to buy is when several indicators point to a strong trend. The right exit time is almost as important as the entry point. Entering a cryptocurrency trade at a good moment isn't a simple task alone. But exiting a trade can be far more challenging. The absence of exit strategy may result in taking premature profits or in unwillingly becoming a hodler of an altcoin. Today we'll also cover the exit strategies and discuss exit peculiarities of different trading styles. Exiting a trade means closing a deal with either profit or loss at a certain point. While it's possible to adapt holding period and reward level of your position to the cryptocurrency market conditions, it's important to grow discipline and follow exit parameters of your original strategy. First rule for a trader is to put his emotions aside, especially in crypto when a coin can skyrocket in one day and hit new lows the next. Many beginners panic if the crypto asset is going in the opposite direction from their trade and close their position with losses. There's also danger for emotional investors if the market's performing too well, since they may be tempted to hold an asset even when the take profit level they set has been achieved. Generally speaking, it's actually harder to exit a trade effectively than to enter one. Technically, an exit strategy is a contingency plan created with the intent of liquidating a position in a financial asset. This is a plan to sell your financial assets. When trading crypto, every trade must have clear targets. You will use targets so you know when to close a trade in profit, and also define a level at which you will know a trade has gone wrong. The hard part is defining these levels for each trade. At the start of every trade you should know your targets in either direction. Always make sure you have a plan before investing in anything. You should think about when you will be satisfied with the result. Will a 20% increase in price make you happy? Or are you someone that wants at least 200% profits before selling? You can find answers by using the step-by-step method. The step-by-step method is a strategy that allows investors to sell predetermined percentages of their investment at certain price points. There is not a golden rule that will lead to definitive success. However, this strategy can prevent becoming too greedy, or selling too late, while still taking profits from time to time. Many investors will always keep 5 to 10% of their holdings for a longer period of time, just in case of a bigger upcycle, or because they firmly believe in the project they have invested in. It is always smart to take profits at a certain price range. A good example of the step-by-step method is the setting of selling point percentage to liquidate 5% of Bitcoin when it reaches $40,700, 10% at $55,700, another 10% at $69,700, 20% at $79,700, 20% at $110,700, and 20% at $168,300. This way, there won't be any missing out if there is a bigger upcycle coming, and any regrets for not taking profit if the market crashes. There are no hard and fast rules for finding the best entries and exits. Instead, there are techniques that you can utilize to help you control your trading and enter more methodically. Over time you will improve and develop your market timing skills. No trader is able to pinpoint the best entry or exit point. It's all about developing a strategy and sticking to it. Remember, it's highly likely that once you initially enter a trade, the market will go against you in the very short term. If you don't time the perfect entry, it's bound to happen. Don't worry about it. Remember why you entered. If your strategy has identified a proper entry, stick to your guns. When it comes time to exit, do so gradually over time to lock in profits. Applying all those strategies can act as a great start for better investment decisions and will hopefully lead to more profits. Remember that every strategy, as well as it may be planned, will always be based on assumptions and calculated risk. There is no way to make a 100% accurate prediction. For that reason, always remember to invest only what you can afford to lose. Please subscribe to the channel. If I bring any value to you, don't forget to press the like button. If you would like to help the channel in any way, use the link below for some free Bitcoin and some free stocks. Thank you for watching.